Welcome to the Mortgage Rate Weekly Market Update for the week of September 24th, 2018. Hello, I'm John Thomas with Prime Residential Mortgage, here to give you an update. While mortgage rates have been moving higher, if you take a look at the bond chart on the screen, you can see mortgage bonds have been selling off since the end of August. They're on a downward trend, which has been pushing mortgage interest rates higher. Now, last week on Wednesday, you can see that red candle. The bond did sell off, but it went way low and then recovered, and it stopped right there at that line of resistance, that red line right there. And then on Thursday, sold off, but then recovered and closed right about that same line of support. And then on Friday again, sold off initially, but then ended the day with a green candle closing just above that line of support. So that's 3 days in a row that line of support is held. So what we're going to do is we're going to recommend carefully floating your mortgage interest rate to start the week to see if mortgage bonds can rally off that floor of support and hopefully recover in the short term. Now, long term, our outlook is for mortgage bonds to continue to sell off, mortgage interest rates to move higher because there's a lot of headwind for bonds. But in the short term, we're looking for a technical thing called the Leash effect. There's a thing called the 25-day moving averages, and when bonds and stuff and treasuries get too far away from that 25-day moving average, they get pulled back towards it. So in the short term, we're hoping for the bonds to pull and rally upward back towards the 25-day moving average, give us some slightly lower interest rates. But that's going to be a short-term effect, and then we would assume that downward trend would continue and bonds would sell off again, moving interest rates higher in the long term. So short term, you can float, see if you can catch a slightly better interest rate while this leash effect kicks in on the treasuries and the bond market. But long term, we're going to see interest rates move higher. There's a lot of reasons for that. We've got inflation is heating up. As inflation heats up, that's the enemy of bonds. The stock market's rallying, which typically pulls money out of the bond market into the stock market. The Feds are going to be done buying mortgage bonds altogether here in October. They've been reinvesting the interest and the payoff, but they've been tapering that off. So that's been happening all year since January. The Feds have been buying less and less of mortgage bonds because that's the only way they can affect interest rates is buy bonds, drive the price up, move interest rates down. So they'll be completely done out of the bond buying market altogether. So that's a player that's gone. So we would see the bond market, bond prices continue to drift lower, interest rates continue to drift higher in the long-term picture, pending any other news or outlook to affect that. So short-term float, long-term rates are going to be going higher. So if you're thinking about buying or refinancing, now would be a great time to do that versus later. Now, if we dig into the economic news, the U.S. stock market is at all-time record highs again. It shrugged off. It kind of sold off a little bit with this tariff stuff going on from the Trump administration, but it has shrugged that off, and it has moved to all-time record highs again. On the Monday, today, the 24th, we have the tariffs, the 10% tariffs on about $200 billion of Chinese goods has kicked in. President Trump has says if the Chinese retaliate, he will impose an additional $267 billion worth of tariffs on Chinese goods again. So we'll see how this plays out in terms of trying to negotiate with the Chinese to get them to have better, fair trade with the U.S. So we'll see how that weighs out. But it's going to be weighing badly on some sectors of the U.S. economy when these tariffs are kicking in. And we're already seeing that in the building section, which we'll talk about in a minute. We did see weekly initial jobless claims come out on last Thursday, and they dropped to 201,000 claims, which is a drop of 3,000 from the previous week, and the lowest figure in 49 years. The labor market for employers is very, very tight. They're holding on to good employees. They can't find enough good employees. If you want a job, you should probably have a job with jobless claims at 201,000. Unemployment rate from the last jobs report was at about 3.9%. So very, very tight labor market for employers. This will also be the sample week used in the September jobs report, which comes out October 5th. So this is pointing to a very good jobs report, which would be not bond-friendly news because we saw wage pressure, inflation start to kick in the last report. So if we see continued wage pressure growth inflation, that's going to be another headwind for mortgage bonds. So that's why short term we can try and float to see if we get the leash effect, but long term we're going to see mortgage interest rates continue to move higher. Now in the week ahead, we got consumer confidence report on Tuesday, S&P Case-Shiller home price index on Tuesday as well, new home sales on Wednesday, pending home sales on Thursday, and weekly initial salvage claims on Thursday. Now, if we dig into the housing news, we had a couple reports come out. We had existing home sales for August 2018 were unchanged from July at 5.3 million units sold on an annualized basis. This is somewhat lower than expectations. We were looking for a gain of 0.4% from July. Existing home sales are down 1.5% year over year from August of last year. Inventory continues to remain tight, but it is up slightly at 2.7% year over year to 1.92 million homes currently for sale. This is the first annual increase in inventory in over 3 years. This inventory represents right now about a 4.3 month supply on average of homes for sale, and homes are staying on the market for an average of 29 days across the U.S. The median home price did move up. The median home price of existing home sale was $264,800. That's up 4.6% year over year. Now, if we turn to new home construction, we saw housing starts for August 2018 rose 9% to 1.218 million units on an annualized basis. Building permits for August, on the other hand, fell 5.7% from July. And building permits are down 5.5% year over year. Building permits is a measure or a sign of future construction. And this shows that there's going to possibly be a slowdown in new home construction if this building permit trend continues. Now, why are new homes construction is up, but building permits are down? Well, builders aren't trying to build new homes right now with these tariffs kicking in, because when the National Association of Home Builders looked at the 6,000 products, the tariffs they're kicking in today are going to hit, 600 of those products are either connected to home construction or tools used to build homes or apartments. So that is what's kind of hitting new home construction a little bit, is these tariffs. Now, if we look into the local news, we got the next first-time homebuyer seminar this Wednesday, September 26th in Wilmington, Delaware, from 6 p.m. to 8 p.m. at the Independent Small eXp Realty office right there on 202. And then Saturday, the 29th, we are in Dover at the Dover Holiday Inn from 10 a.m. to noon. And then we're back again in Newark in October on Saturday, October 20th from 10 a.m. to noon. So you can register for either one of those events in Delaware, but give us a call in the office, 302-703-0727, or online, www.delawarehomebuyerseminar.com. Now, we are in Maryland in October. It looks like Saturday, October 27th, we are in Maryland at Hyattsville, Maryland at the College Park Marriott. That's 10 a.m. to noon. You can register for that event by giving us a call at 410-412-3319 or online, MarylandHomeBuyerSeminars.com. Look forward to seeing you guys next week.